Good morning. This is Jim Colburn of Commodity Research Group. I'm here with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. You can check out our website, commodityresearchgroup.com, where we post our podcasts and blog. We'd like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is June 23rd, and Andy, I think what's becoming a monthly rituals. Why don't we start out with Russia? Good morning, by the way.
Good morning, Jim.
Good morning. We'll start with Russia supply. Now, I've been reading that it might be actually up from recent lows.
It looks like it could be slightly higher than where it was in either April or May. Before the invasion, crude and condensate production was roughly around 11.2, 11.3 million barrels a day, of which over 7 million barrels a day were exported. That went down quickly in April and May to under 10 million barrels a day, and it looks like in June, at least according to their oil minister and also other market watchers, that their production may have increased by let's say 200,000 or 300,000 barrels a day. So, which is not what the EU certainly wanted to see, or the U.S. So, I think right now Russian production is probably around, let's say 10.1, 10.2 for both crude and condensates.
So the numbers that we had seen as consensus were basically that Russia had 2 million barrels of oil and products off the market. Now we expected, or the consensus expected, a total of 3 million down the road. Is that still, you still like those numbers?
No, I don't think that's going to happen. What has happened is that Russia has been able to replace some of its markets in the in the EU. They certainly have been very successful in selling to India. India before the invasion was taking like 50,000 barrels a day, and that's gone up to 600 or 700,000 barrels a day. So a big increase out of India, and it looks like China's lifting more as well. So the barrels are at a big discount, and they're trading. You're not sure exactly where they're trading, but let's say it's still around $30 under Brent, and that's been a big incentive, particularly for India. I think as to the question, the IEA had said they thought ultimately it was going to be, let's say, up to 3 million barrels a day losses. And I don't think that's going to be the number. I think it's going to be between 1.5 and 2 million barrels a day when it's all said and done, and maybe even closer to only 1.5 million. Now, the EIA sees Russian production going down to 9.2, 9.3 million barrels a day by the end of next year. So they've got it down. They've got it down too. I think, as I said, I think 1.5 to 2 may be the final number. Maybe it'll be less than that, Jim. But certainly, I'd be surprised if it gets to 3 million barrels a day. So relative to market expectations, that's a bearish development. Key will be if Ural stays discounted, of course.
Well, I had two comments. One is if I'm Russia, is India my friend or a foe? Because they're buying barrels, but they're taking advantage of deeply discounted barrels. And number two, do you think this is in the market already? Do you think that's part of why we've come off our highs a little bit?
Yeah, I do. I think that is, I think that, and we'll talk about the demand side shortly, but yeah, I do think that, I think that's part and parcel of the sell-off here is Russian output being slightly high, higher than market expects, and going forward, it looks like it's going to be higher than what the market had originally expected, as per what the IEA had said.
And I know, and oftentimes when we have these kind of disruptions in supply or embargo type situations, countries that you wouldn't expect to produce oil, or they produce a little bit, all of a sudden become record producers. Like during the Iraq situation, we saw a lot of oil coming out of Syria, and so I to simplify my question, do you see any slippage like that going on? Like, is it going to be hard to sneak Russian barrels onto the market through some kind of backdoor mechanism?
Well, is it going to be hard? Well, they've been, they have been backdooring it. I mean, they've been, following the Iranian lead by, placing their barrels in different ports, and sort of rebranding them as non-Russian oil, and they've done that with products as well. So there's definitely been
Some of that.
slippage. Now, whether, we'll see what happens in the, on the EU embargo, how much slippage there actually is. The Friendship pipeline is going to remain open. At least the southern part of the pipeline is going to still be open, but 90, Europe is looking for 90% effective rate on European exports, on Russian exports.
Hmm. Let's move over to China, because China demand is really an important part of this supply demand balance. They've gone into lockdowns, and what you've seen some of the estimates of the IEA, the EIA, and OPEC. What's your thoughts going forward, second half of the year for China?
Well, one would think they should, if they come out of lockdown, we should see their production up. They probably lost over 1 million barrels a day of maybe more than that, of demand in the first half of the year. One would think that they will be able to make up those losses, and show some growth year on year, assuming that there's no there's no further lockdowns. But then we're looking at, if there is a recession, a global recession, certainly that's going to affect Chinese distribution, exports, trade, et cetera, et cetera. So I think there's a lot of uncertainty on where Chinese demand is going. We have it year on year up by about 200,000 barrels a day. But before the year started, I think most experts were up 800 to 1 million barrels a day this year, or let's say 700 to 1 million barrels a day growth in Chinese demand. And the first half has basically taken that away, and they're going to really, I think they're going to struggle to get growth this year. Some people are really bullish on Chinese demand, and they're really bullish on price. We're less so,
Hmm.
much less so.
And another area of uncertainty is OPEC plus policy. They have been trying to. They say they're going to increase, or they're allowed to increase by 400, or actually last month it was 600,000 barrels a day, but they can't. They're not making those numbers. Can you just kind of talk about
Oh,
OPEC
they're not
plus?
making those. Yeah, I mean they've got to. They've got to come up with something for when this deal ends, which is in September. The key on OPEC, as you mentioned, is, well, there are two really important points. One, you mentioned, a number of producers aren't going to be able to increase production beyond where they are right now, and they're not even making their number. The spare capacity is in Saudi and the UAE, and we'll see what Saudi policy is. They're about to go up to 11 million barrels a day from 10.5 million barrels a day, where they are just about now. They've never really sustained that number, Jim.
Right.
There is some market uncertainty as to, is that doable? I think it will be, but the question then is, their spare capacity is only a million beyond that, or maybe 1.5 million beyond that. Do they bring that on? And if they do, then the market is going to freak out about no spare capacity.
Right.
So it's kind of a difficult call here for the Saudis as to what where they want to produce. The UAE too can increase production, and then we have the uncertainty. Venezuela, for instance, they may be able to increase production. The Total just lifted some Venezuelan barrels to take to Europe, so we may be able to see Venezuela come up with some extra barrels. And then there's the wild card of Libya. I don't think it's certain what their production is, Jim. One side is saying it's only 100,000 barrels a day. The other is saying it's 700,000 barrels a day. And there's been constant conflict between the East and the West, but certainly we need at least 700,000 barrels a day from Libya, and they've got capacity to probably get it up to 1.12. So there could be another 500,000 barrels a day coming from Libya, which too would be is needed.
Right.
So there's a lot of things going on now where things are happening at the worst possible time.
Right.
And Libya is certainly one of them.
You would think the high price of oil would get parties together. There's so much money involved, right? But that doesn't always happen.
You would, but there's also there's
Deep resentments,
geopolitics,
of course.
right? There's geopolitics.
So you haven't mentioned Nigeria. Have you given up on Nigeria's ability to increase production?
Meaningfully? Yeah, I don't think we're going to see a big increase out of Nigeria. I mean, maybe they could kick in 50 or 100,000 barrels a day, but I don't, I really don't think we're going to see much more from Nigeria. So the key is where the key is going to be, obviously, as always, where Saudi Arabia goes in the second half of the year. I suspect they're going to try to get over 11 million barrels a day, not 12. I mean, that wouldn't be beneficial for the market, I don't think. But I think they're going to try to get over 11, and we should see more from the UAE. Iraq is another producer to watch. This is going to surprise our listening audience, but there is conflict between Iraq and the Kurds as to who owns where the revenue is going. So that's another OPEC producer that probably over the next few years can increase meaningfully over the next 2 to 4 years, not in the near term. So
yeah,
there's a lot, as always. There's a lot going on with OPEC.
So one quick question, do you happen to know what the U.S. president's protocol is when meeting royalty? Are you expected to bow?
I don't think the U.S. No, I don't think we bow.
Okay, I was just wondering because
I don't know if he's going to bow. I don't see him bowing to Prince Salman.
Oh, it's Prince, right?
When and if they meet.
Right.
I don't think that's happening.
You kind of need to follow the news very closely to figure out what the U.S. energy policy is these days, and it spins like a top, and that's I'm trying not to be political here, but that's just what it looks like from a person who's an independent. But anyway, let's move on. So we might not get a lot of relief from the supply side. Let's talk about the demand side for a little bit. These crack spreads, gasoline and diesel distillates, they're out of sight. What happened to the old adage, high price is the cure for high price?
That has not happened so far. Doesn't mean that it won't, Jim, but certainly one of the big factors that we've discussed, I think, is global refinery capacity and U.S. refinery capacity. We've shut or repurposed 1 million barrels a day since the pandemic, and it turns out we probably could have used some of that refinery capacity to. Yeah, we definitely could have used some of that refinery capacity. Right now, there's another 1 million barrels a day of capacity that's offline due to maintenances or operational issues, and those are going to come back because these margins are they're out of sight.
Mm-hmm.
If you looked at the diesel crack today, it was over $70 a barrel. Gas is in the 50s. It's come off some today, but those numbers are in. We're talking about hyperspace type numbers. So refiners. I know the administration has been whining that refiners should produce more, and believe me, with that kind of return, if they could, they would.
Yeah.
And they will when some of this capacity comes on. I think we should see wholesale prices come off nicely over the next into later into July and August, maybe sooner than that. And with it, we should also see retail prices come off because I think refiners are going to make, certainly as if we look at gasoline, I think they're going to make enough and maybe more than enough to meet what looks to be enough, some so far lackluster demand.
Yeah, I was gonna bring that up. Last month we talked about how when you look at the 4-week averages of what is called implied demand of gasoline, it looked like it was starting to flag a little bit. And I'm just wondering, compared to last year, looks like some of the indicators are that we're under last year already.
Yeah,
Yeah.
that's right. We're
So
under last year, and we're way under the the 2019 numbers.
and
So yeah, gasoline is demand is not, has not been e- encouraging at all. It's early in the summer, but it didn't look like Memorial Day was met expectations. And I think going forward, these high prices, at least they do have an effect on demand at the margin, and some people may be forced to replan their what had promised to be a really great vacation, summer driving season. Maybe it won't come up to where to market expectations.
is it the same story for distillates and diesel? Are you seeing the high prices? Because it seems like that's more sort of economy driven, but are you seeing demand in those areas flag a little bit?
Yeah, it looks like the last couple of weeks we're not great on diesel, but it's only been a couple of weeks. So same with gasoline. I mean, you need a larger picture, but it does look like diesel demand is softening. Look, diesel retail prices at the pump are also through the roof. And there was an excellent article, I think it was in the Wall Street Journal, about truckers maybe not taking long routes as they might because of the cost of diesel is making those routes non-profitable.
Right.
So
I'll have to talk.
and you're right about certainly the one thing that gets hit right away if we go into an economic slowdown, is going to be diesel demand, because that's rail, trucking, shipping. So if global trade slows, or manufacturing slows, and there have been some disappointing manufacturing numbers lately. I think we can look for diesel demand to get hit, which is a good thing, because diesel supplies are still globally, they're still really tight. Particularly here in the U.S. Northeast, they're still way too low. So we could use, we need some relief, and we need some supply and demand relief.
I'll ask the guy who delivers Amazon packages to our neighborhood. He told me that they have an algorithm that tells them where to go next, and it doesn't allow them to make left turns. I'll see if the algorithm has a diesel price in there. Maybe it's more efficient now to minimize the travel distance and not so much the time. But anyway,
Jim, it should, right? I
it
mean,
should.
it
But
definitely should. That should be one of the big variables, right? And the algorithm has to be
has to have
has
optionality
to
in
be
there, Andy.
right.
Yeah, yeah.
Well,
So
I don't know about you. I don't know about you, Jim, but I definitely see way less Amazon trucks in the neighborhood
yeah.
than, certainly than during the height of the pandemic.
Oh yeah, definitely. No, and some people are actually going out to stores, but yeah, you're right. See a lot less. Yeah, they were running over each other for a while there. So when you add all this up, Andy, let's talk about inventories, and then we'll get into pricing. But what's we building? We still drawing? Where the heck are we in these things?
Well,
We
we're
balanced.
building. It looks like, it looks like we're building slightly. The IEA talked about OECD commercial inventories building in April and May. We're still way below where we're still. I think the number is, it's somewhere over 200 million still below the 2015 to 2019
Yeah, it's two
average.
90.3, I think.
Thank you. Yeah, I was going to say 270,
Yeah.
but okay.
Close.
So we're still, we need to keep building, and and I think we will. I mean, our numbers are, we're looking for builds going forward. I know the EIA, as it gets into 2023, is looking for like 1 million barrels a day for almost the whole year next year. So, if believe those numbers, that would be bearish going forward. So, you know, these numbers, as always, they're really hard to, at least the demand side, is hard to get a handle on it. And in terms of, we're looking for up 2 million barrels and 2.5, and I'm just about to get that, to reduce that to 2.2 million barrels a day demand growth. And it might even be less than that for 2022, which would leave, more room for growth, particularly if, if we get increases from Saudi and some of the other producers OPEC producers and non-OPEC producers as well. So, we're still seeing surpluses. I know that we're, not on the majority side. I know there are a lot of banks and, some of the Wall Street guys who are talking about the structural deficits. Our numbers don't show it. It doesn't mean we're right, but, I'm looking for builds.
Yeah, it's there's also I think we're still seeing an effect of pent up demand from being shut down for a couple of years effectively, and maybe that demand kind of tails off a little bit. It's not as sharp. Yeah, but it remains to be seen. It's very very highly variable. We've seen
There is one, the other big variable, besides what we have on paper. The other major variable is just the dislocation. You're seeing all kinds of, crazy trade routes developing. just look at the Russia, India, the amount of barrels going to India or China. Some of these product trades is, they're not normal. So, and there's the emotion, right? Are we going to be short this winter, right? Are we going to have enough? So that I think that, that certainly lends itself to a stronger market than what the paper may indicate.
So we've seen weakness in crude, and a lot of it, people are talking about how it's part because the Fed's getting aggressive now. They raised rates, 75 basis points. What do you think's in the market? What do you think's not in the market right now? All the stuff we talked about. I know it's a hard question.
That's a really hard question.
I know.
I think what's I think the market is beginning to discount more of a slowdown and with the potential of a recession. I think it is discounting, and we've talked about this earlier, that Russian supplies may not be as great a losses as expectations, and it's also discounting a long, drawn out war with Ukraine. So I think that it's discounting a lot. I'm not sure we're going to get, there've been all these there've been a lot of a lot of calls on price of $150 or $200. Things are going to have to change, for that to come to pass, I believe. I think the market is getting more comfortable with, hey, it could get, there could be price weakness ahead.
Interesting you say that, Andy. The big open interest in Brent options is the D 150 call around 38,000 and the SEP 150 call 29,000. Those are two of the bigger open interest strikes. And maybe it's a good time to make a couple comments about options. The D 22 100 call is down to 48,000. That's the one we were tracking first quarter of last year. When somebody was building a big position in there. So it's I think the high of that thing got up to like 75,000, but that's coming off. Interesting. You still see more calls and puts trading, but yesterday we started to see, if I look at just Brent options, there were more calls and puts, but puts were active. There was like 81,000 puts to 112,000, and that's that's a pretty good percentage of puts to call volume based on what we've seen recently. And we're starting to see some open interest pick up in the put side. So I don't know if that's one of these major country hedges coming in, but I'd say it's just a little bit different than what we've been seeing. The other thing going on in options is you have the war breakout, market explodes to the upside, volatility explodes to the upside, and now we're in this pattern where implied volatilities are high, but the actual volatilities aren't coming up to that level. So for now, the front month we see implied around 49%, but the 20-day historical is 34. Now they don't have to be related to each other for a lot of. I mean, they're related, but they don't have to be close all the time for different reasons. But when this kind of thing happens, what we see is as you get closer to expiration, people will give up on their option length in the front month and either sell it out or roll it to the next month. So you start to see the front month vol collapse on the back month. And we saw that in Gulf War I. I posted in LinkedIn, and people said we also saw that in 2008 as well. So just for sort of option nerds, you see if that pattern continues. But what else? Anything else, Andy, that we missed?
Would you call would you call yourself an option nerd?
I would say yes.
I think you could be.
Yeah.
I think you could be a captain of the nerd team.
Well, I'm always on the lookout for members, That's why I'm on LinkedIn. So, and on our website. So yeah, definitely get in touch with me if you have the same interests. But yeah.
I think there are many.
Oh yeah. It's funny when I put this sort of I don't, I don't even think it's esoteric, but I guess it's, it's in the world. It's like, I'm I won't say humble, but I understand that options are at best the tail of the dog, and they don't wag the dog. Like some people are really into, oh, look at the skew, and that means this is going to happen. I'm not crazy like that, but it's really interesting to watch the flow of options, and and you can see it show up in volatilities as to what actually is happening, and compare it to the rhetoric you hear, the supply demand stuff you hear every day, and you look at the option market, and sometimes you see something totally opposite happening. You go, oh, that's interesting. Like early on, in 2020, when we saw those deep out of the money puts in the spread options trading, but with big numbers, and we go, whoa, somebody's looking at some serious contango, and sure enough, went to -4. The front one month went to -40. The spread actually went to what, -60, I think. So a lot of people, it showed up to me that significant move showed up in the option world first. So that's kind of stuff I look for. And then like last year in first quarter, we began to pick up on these, these 100 calls of the following year. And I was like, whoa, somebody's, that's an interesting view, and with big size. There's a lot of volume behind it. Anyway, that's that's what I do.
We talked about those D's 100 calls for a long time.
Yeah, and there's kind of right. The market kept going higher, and then of course they get the windfall with the Russian invasion,
Right.
And then you start to see the two-way paper flow of people getting in, people getting out, stuff like that, profit taking, and so moving along here, Andy, anything we missed that you wanted to talk about?
Well, I think we missed a couple of things. One is U.S. Production, U.S. crude production, which
yes.
the the EIA is we're at 12 now. The EIA is saying we're going up to, by December, we're going to go up to 12.6, which I think that's right, at least. I mean, we've been underestimating, or we have been overestimating
Yeah.
where we thought U.S. production was going to be, and it's come out lower than what we thought. I still think it's probably going to be slightly higher than what the EIA has said. There's certainly more. There's definitely more pressure on some of these producers to increase, and I think the administration. And we mentioned that, and we don't want to get too political on this call, but there are certainly some things that they can do, that the administration can do to maybe make things easier. Some of these domestic producers to increase output, because we need it. I mean, and I think the one thing that makes sense to me is to stop bashing them, and try to help them out. But I think looking at where the rig count is and looking where the ducks, we expect production is going to rise faster than what the EIA is saying. So I think that would be a good thing.
I assume that's mostly coming out of the Permian. That increase.
Yeah. Some of the other basins, but the Permian is certainly the most important basin in the U.S. by far. And the other thing, I know we talked about this, is exports and the SPR. The SPR is being released at 1 million barrels a day, so that's like a fairly decent sized producer, and that's going to go on till till November of this year, at which point I think we can expect maybe there'll be another tranche released. It's mostly sad. It's more sour than sweet that's being released, and we're seeing some of these sweet diffs decline, and we're also seeing Brent TI decline. So ultimately, these SPR barrels are going to be exported, which is good. Which is what I think what the plan was.
Right.
This excess would be, this will be exported onto world markets. So it will continue to be watching that.
And I guess we're exporting a lot of products and what HGLs as well. I mean, it's
Yeah,
yeah,
yeah. What's happened is that Mexico is still having problems in their. I think their capacity is only something like 58%, Jim, running 58,
mm,
68, 60%, which is really, unbelievably poor
yeah,
given where the margins are. So a lot of U.S. products are ending up in Mexico. Mexico has just commissioned a new refinery that should be ready at some point in the future. I don't know. It's already doubled in cost from 9 billion to 18 billion, and God
yeah,
knows what it'll be when it's ready to go.
yeah.
I think they had it at the end of next year, but I wouldn't bet on it.
You brought up U.S. oil production, and the other thing we didn't mention was the non-OPEC production. We're going to get some help out of the. Did I see? Was it the EIA or the IEA said that OPEC production might be flat in 2023? And
Non-OPEC?
no, OPEC plus being flat 2023. Part of that's
Well,
Russia, but
it's
non-OPEC.
all Russia. Yeah, it's all Russia.
So, but non-OPEC is going to be up a few million.
Non-OPEC excluding Russia, right? And
Right,
that's
right. Yeah, I'm throwing
mostly
up.
coming
Yes,
from, yeah, that's coming from us, U.S., Canada, Norway, Guyana,
yes.
um,
In Brazil, maybe.
Brazil.
Yeah.
So yeah, non-OPEC production should have a really good year next year in terms of growth, but that's going to be counterbalanced by some of the loss of Russian, and we'll see what that number is.
So do you want to venture out and say, either what a price range you have going till our next podcast, or would you
Well,
do you want to?
we were. I know we were looking for under 105 by July. In July, let's say. So that was actually a good call.
Yes.
Didn't quite have the rally up to
Well,
the recent rally up to 120, but
you know,
at least we had it. At least we had it coming off.
back to being an options nerd, we spend a lot of time looking at the standard deviation or the implied volatility. So when oil analysts, and there's a couple that are out there that say, I think the price is going here, and then in 6 months and they're right, and then you look at the path it took, it
Right.
dropped by $20 first before it went up. It's the path is important, but okay, so we got a fresh
Right.
start.
So but Jim, I came right out and admitted it
No, I
that
know.
I was
Yeah, no,
that I
it's
was wrong.
I'm not. I understand.
I didn't
No,
quite see that. I didn't quite see that one.
it's not, and
Uh,
it's just as hard to try to predict what the standard deviation is going to be derived from the option
right.
market too. So, no,
Right.
I'm just saying the path is important. But so what do you think now? Do you think that's still a good number under 100?
Yeah. I mean, I think we could take a look under 100 easily. The question is going to be, the market is to really sell off broadly. I don't see that because of the lack of spare capacity. I
Right.
think that's a big, that's a big and important issue, and it should be. So, broad scale sell off, I don't really see, I don't see that. We could get under 100, maybe into the 90s. Beyond that, I think it would be pretty difficult. Now, if demand stays really strong, stronger than what we think, and there is no real pullback, and driving is unbelievable in the U.S. and globally and the economy is just cranking away. Could we get back to 115, 120? Yeah, I guess we could. But I know this is also going to shock Jim Colburn, who has sat beside me for, I don't know,
Too many years.
decades.
Yes.
My bias is to the downside. So.
All right. Well,
as usual, Jim.
it's going to be interesting. These inflation numbers, oil's a big part of it. Energy is a big part of it. It's going to be hard to sort of continue the, unless something big happens, to continue the numbers as the acceleration on the upside, basically, is what I'm trying to say.
Right.
These comparisons are going to start flattening out a little bit. And I can't, it's probably a little early to say, but it looks like we've seen the green shoots of a short covering rally in the 10-year note. So we'll keep an eye on that as well. And that may be picking up on, a slower economy and better inflation numbers, stuff like that.
Right.
Yeah.
Right.
Yeah. So the market.
All right. I think we covered a lot.
We did.
If anyone wants to get a hold of us, check our website, commodityresearchgroup.com. If you want to get me by email, it's Lebow at commodityresearchgroup.com. I am on LinkedIn. So feel free to reach out to me or Jim.
Sounds good. Thanks, Andy. See you next month.
Okay, Jim. Thanks.